This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, this is the first lecture in a series of lectures on the BA2 exam. And this lecture, there's no calculations involved. I'm afraid it's all talking. There are a lot of calculations to come in later chapters. But this one is really very much an introduction to management accounting. But within it, there are quite a lot of relatively small things that you can be examined on that you need to be aware of. Now, because there's no calculations, make sure for all the later lectures that you have printed out the lecture notes, because I'm not going to read every word to you, and I'm certainly not going to write every word on the screen. I just want to make sure each bit of it, it's clear what we're getting at, but it's up to you to read it in detail and to make sure you learn it. But first of all, you'll see in the second paragraph a definition of management accounting. You don't need to learn that, you won't be tested at what is the definition, but appreciate what management accounting is. It's really helping management to make decisions. The job of management is to improve the business, to become more profitable and so on. Well, the management accountant is there to help them do that, provide the information they need, help them make decisions to improve the business. It sounds a lot more fancy the way it's worded there. The definition for CIMA, the application of the principles of accounting and financial management to create, protect, preserve and increase value for the stakeholders of both for-profit and not-for-profit organisations in the public and private sector. So we want to improve the business, we want to protect the business, certainly we want to improve it, we don't want it to get worse, and we want to increase the value. So that's basically what we're getting at with management accounting, helping management make decisions. The next one mentions the global management accounting principles. And do learn these certainly could be examined. CIMA was involved in producing them. But as you'll see, there are 4 principles. Now, they actually go into a great deal of detail. You don't need the detail for the exam. All you really need is what's written here. But be clear what each of them is getting at. The first one, communication provides insight that is influential. It's important that, as management accountants, we're providing information, we're communicating information, again, to help people make better decisions. The second one, information is relevant. Again, they need information. How can you make a decision on whether we're going to start producing a new product? How could you make that decision without relevant information to help you? Stewardship brings trust. It's a funny way of wording it, but the assets, the reputation, the value of the business need protecting. Again, it's up to management and the management accountant to help them protect the business, enhance the reputation, increase the value. And finally, the impact on value is analysed. We need to consider different scenarios. Let me give you just one example. A decision management have to make is if we're producing a product, what price to charge for that product? Well, you'll see later, there's a chapter on pricing. There are lots of things management need to consider. But just one thing they might consider is if they charge a high price, they can make a high profit on each unit they produce. But what about instead charging a much lower price, less profit per unit, if that means we're going to sell a lot more? And so we do need to, as it says there, look at different scenarios. Say, what will happen if we charge this price? Oh, we'll sell this many units and we'll make this much profit. On the other hand, what will happen if we charge this higher price? A lot more profit in each unit, but maybe sell less units. Again, what will be the total profit? So we need to look at different possibilities and decide which is the best course of action to take. Now, the next one, you'll see data and information. Be clear of the distinction. And I'll explain by example. Suppose we're a company making a product and we export all over the world. We've got to make a decision, or we're trying to decide, which country should we focus on this year? Which country do we want to try and increase our sales in? Well, of course, to help us, it'd be nice to know how much are we selling at the moment to each country. Maybe we only sell 2% of our sales to China. Maybe we sell 50% of our sales to America. Well, we need to know that sort of information to help us make the decision. And where's it going to come from? Well, we'll obviously have records of every sale we've been making. Sale number 1 was to China, sale number 2 was to America, sale number 3 was to the UK, and so on. Well, that's the data. The data would be each individual, in my example, each individual sale. And all that will be recorded. Obviously, any business will be recording every sale they make. However, what I need to know, for the decision I spoke about, I need to know how much of our sales in total are to each country. Well, that data needs processing. We need to add up and say, oh, well, in total during the year, 5%, or so many $1,000, what percent of the total? That percent is to China, that percent is to America, etc. Well, that is the information. That would be the total sales to each country. It's the data has been processed. So the data is each individual item, each record we've got. We process it to produce information. In this case, we'd simply be adding up the total data for each country. So we process data to get information. It's information that the managers need. They obviously don't want a list of every individual sale. That would be a waste of time. It's up to the management accountant to process it, give them the totals they need to help them with the decision. Paragraph 5, what makes good information? The various attributes that make information good. We can process and give them any figures we want, but clearly, to help them, it needs to be good information. And you've got what we call a mnemonic, if it helps you remember, accurate. I don't know why I'm writing this down, because you've got this in front of you, I hope. But for information to be good, to be useful, obviously it needs to be accurate. We need it to be correct. We need it to be complete. There's no point in giving them just half the information. We need to give them all the information they need, but not excessive. Don't give them lots and lots of information that's over and above what they need. They'll get lost. What decision are they making? What information do they need? And that's what we need to give them. Cost effective. What we mean here is processing data to get information does cost money. All right, my previous example of just the data was the individual sales, the information is when we process, when we've added them up. Well, that's not going to take too long and not cost much, obviously. But more detailed information can take a lot of time to produce, and time costs money. We're paying people wages. And so it does cost money to provide information. It's not worth spending a lot of money unless potentially it's going to give us a benefit, better decisions. So that's what we mean by cost effective. We need to make sure that the potential benefit from making better decisions, that will gain more than it's actually costing us to get the information. Understandable? Well, again, not all managers obviously are accountants. So there's no point in just giving them loads of figures and expecting them to understand it. Present it in a way that's easy for them to understand. You'll see later, perhaps, instead of giving them total sales to each country, it might make it more obvious to them to give them some sort of graph, some sort of chart, a diagram, rather than just a list of figures. But think of ways of making it easy for management to understand. Be relevant. Goes in a bit, overlaps a bit with what I said about complete. Clearly, we only want to give them information that's relevant to the decision they're making. There's lots of information we could gather within the business, but if it's if it's a decision affecting sales, obviously information relating to sales is useful. Information relating to wages would be rather not relevant. Authoritative. The people using it, the managers, must feel they can trust the information we're giving them, because that's what they're going to make their decisions based on. Timely. We want to make sure the information we give them is up to date. There's no point in giving them information about what sales were 5 years ago. What are sales currently? And of course, we want to make sure we produce it on time. If they're making the decision next week, there's not much point in producing the information in a month. It's a bit late. And finally, rather similar to understandable, I suppose, but easy to use. They're making decisions based on this information. They won't have to waste time thinking, why have I got this information? What am I going to do with it? Make it easy for them to use. The next bit rather introduces all the chapters that follow, but the main areas involved in management accounting. Costing. If we're producing goods, if we're making goods ourselves, we need to determine how much it's actually costing us to produce. Surely it's vital. If I'm making desks and each desk is costing $10 a unit to make, clearly that's vital, because when we're determining a selling price, surely we'd want to make sure we were selling it at more than cost. And so it's an important area for the management accountant. And it's not always as easy as it might sound. Making a desk, you've got wood involved, you've got labour involved, all sorts of things. Well, it's one big area, and you'll see we've got several chapters on it later. Planning, or effectively budgeting. But we do need to plan ahead. It's a job of the management accountant. I've given an example there. How many staff do we need next year? We're going to have to start planning and say, well, how many units do we think we'll sell next year? Therefore, how many units are we going to produce? And therefore, how many workers do we need? We need to plan ahead. In most businesses, you can't just say, oh, we need 100 workers today. Where are they coming from? You need to plan and start recruiting workers if we need more. Decision making, I've mentioned several times. But all sorts of decisions we need to make. Which several products we make, which one am I going to make more of? What price am I going to charge for these products? Well, I've already said, a job of the management accountant is to help them make those sorts of decisions, decide on what information is relevant and get hold of it, and be able to apply, you'll see again later, various techniques we could use in order to help make the decision. Control. Another big area, it's something we call primarily variance analysis, which again you'll see later. But perhaps we've done our budgets, and I think next year we're planning to spend $10,000 a month on wages. Well, having done that, A very useful exercise will be perhaps every month to check how much did we actually spend on wages. It was supposed to be 10,000. And maybe we find in January we spent more than 10,000. Why? Maybe with no choice. We produced more, we needed more people, fine. But maybe something's gone wrong. We're paying more than we should. Well, we need to keep control. We need to check. Are we spending more or less than we expected? And if we are, we need to find out why. And if there is a problem, we need to try and sort out the problem so that in later months we're not overspending. And finally, performance evaluation. Again, you'll see chapters on this later. I don't know why I'm writing all this down, but still. It will be important that we need to measure how well our managers are performing. Are they doing a good job and perhaps deserve a bonus? Or are they doing a bad job and perhaps need more training or even replacing? Well, we need to find ways that decide how we're going to actually measure how they're performing. How we're going to check each year. Are they doing well? Are they doing badly? And equally, if we've got divisions, if my company has several factories around the country, we want to be able to look at ways of measuring how well is each factory doing individually. Are some doing extra well? Great. If some are doing badly, why are they doing badly? How can we improve things? Over the page, nearly there, but I've kept saying management need information from the management accountants. Management need information to help them make decisions. And we say there are different levels of planning. And depending on the level, they'll decide to need different types of information. And you've got the 3 standard levels there. First of all, strategic planning. It's here looking at long-term plans. Now, there's no precise definition of what's long-term. I've put there, for example, 5 to 10 years. But we're talking about long-term decisions. And I've given you 2 examples there. We're thinking of opening a new office. It's a long-term decision. We're wondering whether to launch some new products. Again, it's a long-term decision. It'll have a long-term effect. And surely for that sort of decision, which is usually made by top-level management, the information they need, they won't need very fine detail, but a lot of the information they'll need will be what we call external information. If I'm thinking of launching a new product, I'll need a lot of information about how many other companies are producing the same product. What price are other companies charging for this product? What sort of demand in the world is there for this product? That's very much what we call external information. There's no records in within our company of what price competitors are charging. We'll have to find out. It's external. Anyway, they're long-term decisions. We won't have detailed costings. But overall, does it look worthwhile to launch this new product or doesn't it? The next level down is what we call tactical planning, where maybe top management have decided we are going to start producing a new product. In the long term, we think it's going to be worthwhile. All right, in the short term, it may not make much money. It'll cost a lot of money to start producing and advertising and things. But we think in the long term, this new product is going to be profitable. So at the strategic level, we've decided to go for it. Having made that decision, we need to start making more detailed short-term plans. We're a company making desks. We've decided we're going to produce chairs. We've made that decision. But now we have to look more to the short term. How many new staff will we need to be able to start making chairs? What new equipment are we going to need? And so on. So this is more short term. An example of it is our budgets. Usually companies budget for a year at a time. And again, we'll chat on budgeting later. But let's now budget over the next year. Let's plan what resources we'll need, what labour will I need, what materials will I need, and so on, to be able to start making this new product, to start making chairs. So this tends to be much more short term. For example, our 1 year budgets, but again, that's not a rule. And the sort of information you'll need is both external and internal information. I said a moment ago, if we're thinking of producing new desks, a new product, chairs, we'll have to start budgeting how many workers are we going to need, how much are we going to have to pay. Well, some of it's internal. Let's look at our current workers. Have they got spare time? How much are we paying our current workers? How good are our current workers? How fast do they work? Some of it's going to be external. If it needs new skills and we need new workers, how much are other companies paying for that sort of worker? You know, because whatever they're paying, presumably we'll have to pay the same if we're going to attract new workers. And finally, different levels, operational decisions. My example, at the strategic level, we've decided we are going to produce this new product, chairs. Having decided that, at the tactical level, we've done short-term budgets in more detail. How many chairs do we want to produce? How much labour would it need? And so on. We then move to the operational level, the day-by-day running of the business. So this is very much day by day. It tends to be much lower level managers. You know, the manager in charge of the factory, for example, is going to have to make decisions. He's been told we're going to make desks. He's been told, chairs rather, he's been told how many workers to employ. But on a day-by-day basis, we're going to have to make decisions. How many do we produce today? Which suppliers should we choose to buy our materials? And so on. And the information they need is very much internal. Information within the business. Okay, I keep saying nearly there, but there are only two more headings to look at. The next one, comparison of management accounting and financial accounting. In this paper, it's management accounting I'm concerned about, not financial accounting at all. That's paper BA3. But a lot of people do confuse the two, especially because it's very often the same team of accountants that deal with both aspects. Again, I'm not going to write down what I've typed on the page, but financial accounting is very much producing statements at the end of the year, reporting what's happened in the past. At the end of each year, businesses are required by law to produce a statement showing how much profit they've made during the year. They're looking at the past. Maybe a profit, maybe a loss, but their job, financial accountant, is to report what's happened. And there are lots of rules, you know, there are laws in each country requiring these statements, and what the layout of the statements is, and so on. Management accountant isn't really bothered about what happened last year. The job of the management accountant is always to make things better for the future. So they're always looking to the future. There are no legal requirements. Companies do budgets not because they're legally required to, but it helps them plan for the future. So financial is very much looking at the past. The management accountant's looking much more at the future. The financial accountant, there are lots of rules, laws, accounting standards telling them how they must present these statements and so on. The management accountant, there are no rules. You'll see as we go through various ways we can look at things, but there are no rules. The management accountant does things in whatever way is best for the business. Okay, finally, it's a bit disjointed here because it is very much introductory, but CIMA has professional standards. They require all their members and students to be professional, to abide by these 5 fundamental principles. It's a requirement, becoming a CIMA qualified isn't simply passing exams. To be allowed to call yourself CIMA, you need to keep to these principles. These I'm not going to write down on the screen, but integrity. They must be honest. Objectivity. They're not biased. It's not up to the management accountant to make things look better than they are because it'll make your manager happy. Or to make things look worse than they are for some reason. It's up to them to present things as they are without any bias. Let top management make decisions. It's not management accountant provides the information to help them, but doesn't try to force them to make a decision. Professional competence and due care. Management accountants are expected to know what they're doing. Although I say there are no rules, there are various standard things we consider, and we'll look at all the relevant things in later chapters. But you do expect them to know what they're doing and be competent, to be good at what they're doing, and to take due care that they're doing it properly. Confidentiality, I think an obvious one. Clearly, it's not your job to start telling competitors what's going on in our business. Not a question, it's not your job, you mustn't, it's confidential. What goes on in our business is kept in our business. And finally, professional behaviour. In everything they do, they should act professionally. CIMA has a reputation as a good qualification, as an honest qualification, and so on. They don't want their members and students damaging the reputation. And it's not just a question of doing a good job in the work, but outside work as well. It's not very good for CIMA if there's a big article in the newspapers about somebody who's committed some terrible crime, and it happens to mention that they are a member of CIMA. As I say, it's not very good for CIMA, it's not professional. You're expected to be professional in everything you do. Okay, so that was a lot of talking. I'm sorry. In the later chapters, we'll get more and more into the numbers. But every individual paragraph in this chapter can end up being 1 or 2 questions in the exam. So the only real detail you need is the detail I've typed here. And I hope the lecture has, made it clear what we mean by each of them.